Hi, a very good afternoon or evening to everyone here, and a warm welcome to the webinar on investment preparedness. So I'm Joy from the AVPN DealShare team, and today we are very happy to have here with us our content partner and AVPN member EY here with us today, and they'll be sharing about three key topics on investment readiness, identified as common challenges. And we are very excited to see a room full of enterprises and capacity builders here with us today. And we're very glad that all of you can join us with us today. Now, a brief background of AVPN and DealShare work before we start. AVPN, we are a members network of funders and resource providers in the social investment community. And at DealShare, we aim to bridge that gap between the demand and the supply of this ecosystem. And we do this by supporting social purpose organizations to gain resources, as well as potential funding from our members. We also work very closely with our members, like EY, to curate various capacity building programs, like the current webinar we have right now, to help social enterprises become investment ready. And what we have observed is that one of the challenge areas commonly cited by funders and social enterprises is the lack of a common language to assess how investment ready a social enterprise is. And in response to this, the Social Enterprise Development Toolkit was launched last year, a joint collaboration between AVPN and our members to help to develop this common language framework for investment readiness. And most of you who registered for this webinar might have the chance to take the online Toolkit questionnaire, where your enterprise would be assessed based on your investment readiness level across 8 business verticals, which are important factors that funders typically use to evaluate how investment ready their enterprise is. And with this toolkit, we have also identified resources that the team has mapped and identified to help SE scale. And as you can see in the chart, we have collected responses from the social enterprises, and majority of the enterprises are raising, in this room today, are raising early stage investments with an overall investment readiness of ranging around 2 to 3. And we also do have a handful of enterprises in the growth stage as well. And most of you have also identified as market and exit and acquisition as 2 of the lowest level of investment readiness. Common challenges that we have identified as well from your responses, including financing option for early stage enterprises, conducting valuation, and managing cash flow in light of the current COVID-19 situation. And at our AVPN conference last week, we also conducted a poll on 800 delegates, and the results gathered showed that most delegates identified having a sound business model and clear financial projection as the most important factor to assess how investment ready an enterprise is. And so with the above analysis as well as the responses collated, the EY team has curated this webinar in line with some of these challenge areas and critical factors that we hope can help to accelerate your enterprise level of investment readiness. And I'll now pass my time over to Jessie. Jessie leads the EY Global Impact Entrepreneurship Program, and she will share more about the agenda and program for today. Jessie, over to you.
Thanks, Joy, and hi everybody from a rainy London this morning. It's wonderful to connect with you all, and I can see the room filling up, which is fantastic. Firstly, just like to thank Joy and the whole AVPN team for inviting EY to connect with the AVPN network and share our learnings. As Joy mentioned, my name is Jessie Coates, and I lead EY's work globally to support impact entrepreneurs. And given the feedback that you provided through the Social Enterprise Development Toolkit, we wanted to curate for you an agenda to hopefully cover some of the most critical topics on your mind. So how to prepare for investment, considering the different financing options available, and how to structure an effective business plan and pitch. How to value your enterprise, of course, something that's really important to get right when entering negotiations with investors, and also how to manage your cash flow, which is, of course, always critical for small and growing businesses, but is particularly topical now, given the impact that COVID-19 has had on the economy and on individual businesses. I'll start by sharing a very brief introduction to EY and how and why we're so proud to support impact entrepreneurs before passing over to my colleagues, Vic and Yoga, who are leaders in their field, to provide really practical tips and guidance around these 3 important topics. And then we'll close by sharing some of the services and resources that EY provides on a not-for-profit basis to impact entrepreneurs globally. The session will last for around 60 minutes and will be recorded to enable you and your colleagues to watch on demand. I'd also highlight that while we're aiming to share leading practice insights, we do really value interaction from the audience. So please do post your questions via the Q&A chat as we go, and we'll aim to directly address as many of them as possible, either through the chat or through the moderated Q&A sessions, which will be facilitating in relation to each of the topics. So as I mentioned, I'm joined by two of my EY colleagues who have both deep experience of their respective competencies working with many of the world's leading organizations, but who also have direct experience of working with early and growth stage businesses to help them overcome barriers to growth and access financing. Vic Sharma is an associate partner in our M&A advisory practice based in Singapore. He has more than 13 years of consulting experience with close to 10 years in corporate finance, advising on mergers and acquisitions, fundraising, post-merger integration, valuations, and strategic reviews. He's also been active in the startup space and has worked with several entrepreneurs on their financial models and business plans. Yoga Prawita is an associate director in our M&A advisory team based in Indonesia, with a focus on M&A deals, strategy, and commercial due diligence across the ASEAN region. Yoga has more than 12 years of consulting and corporate finance experience, with 9 years in London and Amsterdam, and he's also been involved in numerous fundraising processes in the startup and health tech areas in Indonesia. So, as a quick introduction to EY, we are a global leader in professional services, including assurance, tax, transactions, and advisory services, and our purpose is to build a better working world. We have 300,000 employees globally and offices in over 150 countries, and we serve the world's largest businesses, governments, and institutions to build trust and confidence in the capital markets and in economies. And EY Ripples brings together that global EY network in an effort to achieve one shared vision, to positively impact the lives of 1 billion people by 2030. And our intent is to engage all of our people in not-for-profit activities to achieve that bold vision by focusing on the areas where EY can best leverage its core capabilities to create impact at scale. EY Ripples has 3 distinct focus areas where we believe our global knowledge, skills, and experience can make the biggest difference. The first is supporting the next generation workforce. The second is accelerating environmental sustainability. And the third is working with impact entrepreneurs, helping to scale small and growing businesses that are driving progress towards the United Nations Sustainable Development Goals. And with billions of people still excluded from access to decent work opportunities and goods and services, and obviously that's been exacerbated by COVID-19, we truly believe that you, as a very special breed of innovators that we call impact entrepreneurs, are at the heart of how we can achieve a better working world, where everyone can contribute to and share in the benefits of sustainable, inclusive growth. And so to serve this vital group, EY teams around the world provide a range of services to bolster your scale and success in the critical early stages of growth, from webinars like this to digital tools, mentoring and coaching programs, as well as long-term capacity building support. And with that introduction to our work, I'll pass over to Vic to jump into the first topic for today's session around preparing for investment.
Thank you, Jessie. Thank you so much for the brief introduction about EY and what we guys do. Very good afternoon, all. I am dialing in from Singapore, so it's good afternoon. I don't know where you've been dialing from, but I mean, a very good day to you, all of you there. I understand a lot of people have dialed in from different parts of the world and with different questions. So I, first of all, want to start by saying I am humbled to be given this opportunity to sort of speak with 27, 28 people who had the courage to start their own startups. I must start by saying that it's not easy to sort of jump into this journey because it's very difficult, it's arduous, and it questions your decision why you have done so at the very onset, and therefore every day is a challenge. And though I would think investment banking and consulting is are one of the two very rigorous sort of professional line of work, but I would definitely tell you very honestly, I have worked with a lot of entrepreneurs, and I really respect all the people who have taken this jump and started their own startups. So thank you for giving me your 45 minutes to listening into these three topics that I'll probably cover. I'll start by, I mean, we've got three interesting topics, and I must say that these three topics are, I would say, would require close to a day in each, right? If you were to sort of really cover them in depth. So I apologize from the very onset if I would not be able to sort of cover things that you would have expected from this session, but we would try to give you a fair idea of each and every topic, which is preparing for investment, valuations, and cash flows, and how do you look into it from a very high level perspective. And then if you have any questions, we'll be taking those at the end of each session. Today with me, I have Yoga, who's going to support and who's going to sort of lead some of the detailed analysis or detailed questions that you may have on each of these topics. So starting with the first topic of today, which is preparing for investments. And I believe this is one of, I would say, based on the feedback that I've got, this is the second most asked question. Obviously, valuation is the top question people had questions on or queries about, but we'll come to valuations in a while. Starting with preparing for investments. I think that when we looked at this particular question, we thought of ourselves, what would you like to know? And effectively, there were two questions or three questions that we were thinking to ourselves that we should answer. One, I think how to help you prepare for investment would be to give you enough tools required for that, and also the critical thinking that's required before you start with your investment journey. So the first part is critical thought, i.e., what are the key considerations that you have to think before you go for investment or prepare yourself for investment. And the second half of the first section, where Yoga would probably would give you a little bit more details about how to perfect your pitch or how to do a business plan. Yeah. So starting with the first topic, which is key considerations when preparing for investment, I would say the most important question that one needs to ask is, why do I need to get the investment? That's a very critical question. And for what? So effectively, it's knowing your financing requirements, how much financing you need, and who am I going to get this from? And accordingly, I need to sort of really polish my pitching, because the pitch has to be very different to the person you are talking, having conversations in relation to getting the funding. Now, the amount of money that you're looking to raise will depend on why you are raising this amount. If you're raising the amount for your capex, if you're in, say, for argument's sake, if you're in a manufacturing business, you would need a lot of capital, and therefore you'd probably be looking for bank loan. Whilst if you are at the very onset of your journey, where you're starting to start a business, you might be looking at, okay, fine, let me start by developing a product prototype. And how much do I need? Maybe a small amount of money, and I could go to my family and friends to raise that. So depending on why you're looking to sort of raise, you probably then move into how of it, and how do you fund that particular requirement of yours. Yeah. So this is on the slide. There are a number of options which people must be facing or are questioning themselves why they need to raise the fund. At the same time, on the right hand side, we've listed a number of options where you could raise those capital. But I'll cover these in detail in the following slides. Yeah. So effectively, if you look at the financing methods, the way we guys look at it, the way advisors look at it, it is primarily compartmentalized into 5 different buckets. And all these buckets are sort of, you've compartmentalized them based on the interest burden, based on ease of getting them, based on the conditions they put onto you as a founder of a startup. So let's start with the first, start with the left-hand side, self-financing. We all know that's the cheapest available option in the market. However, the quantum is often limited, because if we were born into rich families, probably we would be not even having this discussion, because I could probably just go to my father or draw into my savings and I could start a company. But often the challenge with self-financing is it is indeed constrained. We have limited pockets, we have limited savings, and therefore we can't achieve everything with it. also, because it's short and we don't have ample of it, we probably have to wait a long time to implement the entire thought process or entire idea or things that we want to do with our business. Therefore, often in our industry where we are trying to sort of beat the market, time is of essence. Therefore, if we have capital on day one, that solves a lot of problems. Self-financing, on the way we have put on the slide, it is more from the business standpoint. If you are running a business and that's fairly mature, you would probably look internally first to get financing for any new ideas you've got. And for that, you will either tap into cash reserves of your business, or you would look to one of your assets which you're not using to sell it and make some cash. The other alternatives are trying to manage your working capital, but that's a little bit tricky. You have to plan for it, and we'll come to that in the third section, managing cash flow. Yeah, so moving to the second source of it, which is independent financing. This is still where you don't get to those big banks offering you the service to take a typical term loan or a working capital loan. But these are friends and families who you would think of. Some rich uncle I had, or maybe my HNI friend somewhere, or maybe my professor I met sometime who had the same idea shared with me, and probably he would be interested in funding my idea. I mean, these sort of people. And the reason why this is interesting is because this is where I would say most of the startups would have raised their first external money from friends and family. So therefore, these are very important. Off late, and I think this is really helpful, and this has become really, really instrumental and powerful, are the crowdfunding and lending platforms. I know that I have used a number of them to fund a few of the startups that I've invested in. So these are very powerful tools. So I would encourage all of, the people on the call to please utilize them to the extent possible. And clearly suppliers and buyers, and we'll come to that afterwards in the cash flow, because that's again your own stakeholders. Grant financing is very important in the COVID-19 era. As you would know, a lot of governments have come up with a lot of schemes, and this is typically a capital which comes, I would say, after you've put in your effort, after you've qualified the mandate, it comes to you on a non-repayable basis. So that's very interesting. That's very, very interesting. Because you could get the cash once you have the cash, it is typically with you to utilize in the way you seem right. However, that might not be the case, because some of these funds are very specific, i.e. you could probably use them for, say, capex purposes, or they're exclusively to pay to your staff, which in a way is okay, because at the moment cash is cash. You would have to use some form of the cash to achieve these purposes. I would say, please, grant financing is the must. And in this environment, if you were to ask me what's the best way of stretching your runway, I would say grant financing, because governments are very liberal in terms of supporting the economy, and this in COVID-19 times has become one of the important sources. So people can't ignore this if you are in the startup space. Next slide. Debt financing. Once the startup reaches a state where I believe the growth trajectory is visible, the product is finalized, and it has been proven, and now it's a matter of going out and doing things in a big scale, or maybe scaling up in different geographies. The first thing you would do is you would probably go to the banks, or you would probably go to the other credit funds to fund your expansion. And the reason why people look at debt before equity, and that's usually the trend, because you don't lose out on control, you don't lose out on ownership. And effectively, I would suggest people that debt financing is important, but the problem is with debt financing, it often comes with a lot of requirements, i.e. your net asset, your collaterals, they're heavy. And also the banks, once they understand that you are in a difficult situation, they'll probably be, sometimes they can be supportive, and oftentimes they can become really, really problematic as well. So therefore, and there are different ways of using the finances from the banks, and these could be your term debt, this could be your leasing, hire purchase, overdraft for the short-term period, just to say to support your purchases, etc. Or there are some in recent innovations. I wouldn't say recent because they are not at least a decade old, like factoring, inventory financing, all these things. And there are numerous avenues for you to sort of utilize these sources, but just that you have to match your liabilities with the assets. And I'll come to that in the third section. Last is equity, and I'm sure all of you, if not all, at least most of you, would be comfortable about, on this one, because that's exactly what the question is here. Who's going to fund my startup? Yeah, and how am I going to convince these guys to take risks along with me? The good part about this is, if people believe in your business idea, they would be sharing your risks and also the upsides. Therefore, they become your partner in crime. However, as it is with any activity, you would want to choose your partner in crime very carefully. And therefore, it is very, very important that you choose your angel investors, your venture capital, your PE, your impact investors very, very meticulously. Because often what happens is when we are there for cash, we will take cash from anybody. And I have personally seen cases where this will haunt at the subsequent stages, where there is a tussle. They would probably become very difficult in terms of executing all those terms, which they would put typically in the shareholders agreement. Now, just for covering the literature part of it, angel investors would probably invest a little bit in your. They wouldn't take control, but they would be giving you a small amount of money for a small portion of equity. PEs typically like control. VC would take in, say, roughly, they would fund your early growth stages and they'll ask you for a minority. And social impact funds are, it varies typically. And I think most of you would have a question how to get VC money. And that is something which I believe the next subsection is going to cover. Obviously, there's no right or wrong answer, and I can't introduce you to the VCs who would say, hey, please invest in this startup. It has to be all hard earned. It's very hard money. But Yoga in the next section is going to cover about the pitch and the business plan, which is very essential to make an impact on those VCs, because they are actually chased. You wouldn't believe. I was talking to a number of VCs, but one classic example one real example that I can share with you is a guy, a very good friend of mine, and there are a few of them in London. He was sharing with me that, on an average, he will evaluate 2,000 proposals to invest in, say, 20 startups. And of the 20, only two are going to make money. And VCs are therefore very, very sharp in turning on the proposal. That shouldn't really disappoint you, because there are numerous VCs who would be looking to fund and fantastic ideas that you guys have today come up with. So depending on what your theme is in terms of the business idea, people have different avenues to explore. And I would say more impact oriented startup you have, better it is to align yourself with one of those impact funds, endowment funds, some charitable organizations, because that really is helpful. On the slide, we've tried to demonstrate typically what businesses would go after, what sort of financing, and what sort of financing is available, and that's for your consumption. I think what we will share with you in the next subsection is going to be very interesting. So this is the right point where I introduce my colleague Yoga, who will cover how to perfect your pitch and also the business plan. Yoga, over to you.
Yoga, I think you need to turn your microphone on.
Apologies. Thank you very much. Yeah, so thank you very much, Vic. So I'm truly humbled to be able to take part of this webinar. So hopefully I can share some practical tips based on my experience, when it comes to preparing for investments. I think I'm going to try to cover 2 slides. So the first one is on the how to prepare a pitch structure, right? So I think On the slide, I think you see that's the some of the leading sort of structure that we've got. But the key things when it comes to preparing your pitch, as my colleague Vic mentions, I think when it comes to VC, they've got limited time, so you ought to do it in a succinct way in a very effective manner. So typically, I think my tips would be to focus on the why of your investment, right? So to focus on the problem statement. What is it that you're trying to achieve? Based on your business model, to provide cutting-edge solutions, and then give a clear vision and missions, and also explain who the team is. Typically, I think in early stages of investments, I think team and the founder will play a big role, right? To secure funding early stage in your in terms of your life cycle of your business. And also typically investors would like to get some sense on the business model and the level of competitions. And then this is typically placed in the early stages of your investment cycle. And then the next slide, I think I'm going to try to cover sort of what we call as the more detailed sort of pitch deck, right? So we call it as I think my colleague Vic mentioned that too. Having a robust business plan is essential. I think typically some of the leading practices you've got to prepare around 25 pages, depending on sort of the size of your company. This is really crucial to make sure that you provide enough information to the investors, because the investors typically will use this information as a basis to form a view on the when they submit a non-binding offer, right? Which is the before they submit the final binding offer. So the informations ought to be detailed, right? So typically cover the quick overview of your company, a clear investment highlights on what is it that you're trying to achieve, a quick overview on your business model and how you scale up, how big the market size is, as well as the risks around your company, as well as how you project your financial forecasts and what are the key assumptions. I think with that, I'm going to pass it on to Jesse. I think we've got Q&A sections now for this session. On to you, Jesse.
Perfect. Thanks, Yoga. And we will indeed now open up for our first round of Q&A. So please do remember to type your questions into the Q&A box, and we'll try to address as many as possible. I'll maybe start with one. It's come in. I think a very common question, and Vic, if I can maybe kind of pose this to you. You talked briefly about some of the challenges that you have seen arise between entrepreneurs and investors, but maybe you could share a few more challenges that you've seen kind of firsthand occur between entrepreneurs and investors during the investment process, and maybe some tips on how to navigate and resolve those.
Sure. Thanks, Jesse. I think it's a very powerful question, and the reason why I think this is a very powerful question is oftentimes the challenges can be overcome. It's just a matter of perseverance. It's a matter of convincing the other side. So when the key question you've asked me, what are the challenges between investors and the founders, and why is there is a gap? I would say it is broadly to do with four things. One is strategy mismatch. So if say for example, what you're trying to do in terms of your startup, the strategy is not in line with what the VC or the funding institution has seen commonly in the geographies, it'll be challenging for them to fund you. Secondly, or it could also be about the mandate mismatch. When I say mandate mismatch, oftentimes the founders that are on the call would probably benefit from the fact from being a little bit more flexible, because often some of these institutions have a very clear-cut mandate in what type of startups they can invest. So I'll give you a very typical example. If you are in a manufacturing business, but you are manufacturing something which feeds into the healthcare ecosystem, and if you could position your startup as a healthcare player, therefore, I mean, you could actually be opening up yourself to a number of investors, So a couple of things, and then the other points could be views in market. Some people might say this market is not attractive, whereas you are from that market, therefore you will view the market pretty strongly. and obviously pricing. And we'll talk about pricing in the next section. So, I mean, that's what I have to say on the particular question.
Thanks, Vic. And I think in the interest of time, we have a few questions coming through now. We will continue to address those through the Q&A chat function. But in the interest of time, I suggest we move on. And Vic, I'll pass back over to you to begin the next topic of valuing your enterprise.
Absolutely. So, I mean, that's very interesting. Thanks, Jesse. The reason it's interesting is because I could continue from where I left, after, I mean, while I was trying to answer your question on pricing. Valuing is as it is, as it is with the matchmaking, it is always subjective, I would say. People think there's a huge amount of science behind it, but once you understand the basic facts about valuation, what remains is generally art. And it is a very tricky situation because generally there's no right answer or a wrong answer as well. So the way you look at your startups may be completely different from the way the investors looking at the startup. And that's purely because maybe he doesn't know about your industry. Maybe he doesn't know about your startup. So it's a matter of convincing why you value or why you see value in your startup at that particular level, right? And that's where the deals are made. I mean, if you can try to see what are the challenges behind investors' valuation and try to help him a little bit, and yourself be a little bit more flexible. If, say, for example, the investor is meeting a number of other expectations, perhaps you could shift down your valuation expectations and meet in the middle. So slide on that you are seeing at the moment on the screen just depicts that. Often the deal is struck at the range that's common when the two valuations meet. And that's the key to striking a good deal. Now, how do you value a business from the science standpoint? That probably I'll be covering that in the next slide, and I'll give you the overall flavor of it so that you understand the basics of it. And I'm sure, I mean, with people, with the audience that we have today, I am sure that they can give me lesson on valuation because they must have had a number of conversations with the investors already. So please, I hope what I'm trying to do here is, I hope you don't take it otherwise. All I'm trying to do is communicate what I've been taught to me and what I've been using in the past 13 years. This may not be the only thing you have at your disposal. So please feel free to flex these things. Yeah. So there are three basic approaches of valuing a business, and these are very simple. If you were to look at it, the terms may be difficult, but if you look at the underlying concepts, very simple. And I'll take examples for each of it. I'll start with the easiest one first, which is on the right-hand side, the cost approach, which you would not use for a growing company. And why you would not use for the growth company? That's because growth company, all the value comes from the future. And whatever you've invested to date is just the present investment. And that cannot reflect the value. That cannot reflect the intangible. Therefore, the cost approach can't be applied for a growing company, whereas it could be applied for companies such as in the sectors of real estate, where the location, the property, the tangibles have values. And when you are valuing such businesses, you probably use usually use two methods. One is adjusted net asset method, which simply put is your assets minus your liabilities is your net value of the business, and you transact NAV. Which is what you would see if you were to look at transactions happening in real estate in REIT space. The other one is replacement cost method, which is very difficult to understand, but I'll try to sort of make it simple. So if you bought a house 5 years back that was worth 5 million, and today that house is worth 50 million. On the books, it's for 5 million, but you would probably not be selling it for 5 million. Why? Because there's a replacement cost. Nobody can get the same house for 5 million. Therefore, the cost today is 50 million for the particular house, and that's replacement cost method for you. So how much would you need to replace this business today is the real essence here. Now, coming to the first one on the left, that's very interesting, and that's where I think most of these startups would be looking to sort of value themselves on, and that's market approach. Market approach is sort of looking outside. You don't look at the company, but you use some parameters of the company and overlay it on the matrices that are thrown by the market. And what do I mean by market? say if you are a health startup, and I am sure there are a number of, I was looking at the profile, there were a number of people who've started the businesses in healthcare. So say I'll take an example of a primary care, which is, I mean, there were a couple of primary care startups who signed up for this session, right? If there are primary care players listed on stock market, you would look at their price to earnings, price EV to EBITDA basis, and you will use your earnings to just use that multiple to value yourself. That's comparable company method. The other one is comparable transactions. Say if you are aware of a company that's in a similar business in the same geography, and somebody paid 5 times the earnings that the company was making, that is a parameter you could use. So that's market approach. The middle approach, income, is the most powerful one, because that approach tries to value your cash flow, the cash flow that the company generates, and also in the future, and discount it to calculate the present value of the money. And that is what my colleague Yoga is going to explain to you in detail, because that's worth understanding a little bit more of how do you calculate the cash flows to discount. Yoga, over to you.
Thank you very much, Vic. Thank you. So when it comes to income approach, I think based on my experience, I think some of the practical tips that I think we ought to consider, right? So I think that number one is this goes hand in hand with how you lay out your business plan, right? So typically it's got what we consider as 3 stages. So first you need to sort of come up with a detailed planning periods, for the next 3 to 5 years. And then the next stage is what we call as the transition period. So I think one point on that is the level of speeds on that periods in the light of what you see in the markets for similar companies. I think that's something that is crucial to consider. And then the last stage is the steady states, where I think most of the I guess the unicorns, some of the big startups already are looking to scale up and sort of further monetize the existing users and user base that they've got in their companies, right? So you start with the future, right? So this goes hand in hand with business plan. So you come up with a detailed business plan has got a detailed product level sort of informations, right, for the coming 3-5 years, and it's a functions of volume and price. So you ought to have a good idea around the market size and what is how much is the market growing. You look at other companies, similar companies, what was the rates that they can grow and how long does it take to achieve a certain level of operations. And then the next thing is the market share. So you've got in a company, you look at the competitors in the markets, you compare that with your product and see whether what sort of relative market share you've got currently, and think beyond that how to sort of penetrate further, form some partnerships, strategic partnerships in the markets. I think that's quite crucial. And also cost structure, right? When it comes to detailing your business plan, you need to have a good, a clear sort of information around the cost structure, fixed and variable costs, right? With links to sort of will drive to the level of margin that you're projecting, right? So at the GP level, EBIT or EBITDA or net profit level. The next thing still on the detailed planning is I think my colleague Vic mentioned that, is on the CapEx, right? So what level of investment you need to sort of achieve the projected revenue that you're forecasting, and also the level of working capital that you require, right, to sustain the business, and also level of investments that you need to to allocate, right, the cash tied up in the working capital. The second point that I would like to mention here is do not never rely on a single forecast, because when it comes to estimating your future cash flow, I think you ought to consider different scenarios, right? So in terms of size, in terms of competitive landscape, level of margins, and think about given this COVID situation, I think is crucial to consider what could go wrong, right? And looking at it from the commercial standpoint, looking at it from the legal standpoint, operational standpoint, and financial standpoint, whether or not that what we've got as our forecasts for our projections still making sense. So that's often, I think, I see in the real life. I think some of the companies, I think, fail to recognize that early, so they might have problems at later stages. And the last thing is apply probability weighting, right? So to each of the scenario that are relevant to your company, right? To come up with this reasonable valuation range, right? I think as my colleague Vic mentions, I think when it comes to valuations, DCF model, you will get an output, but I think you need to assess that also in conjunctions with the other valuation methodologies. So I think when it comes to startups, I think you need to consider the enterprise value, EV revenue, commonly used, and also multiple of gross merchandise value that's also often used, and also the customer acquisition costs, as well as the daily active user. I think those are the key metrics when it comes to valuations. Be prudent. I think that's the one thing that I would emphasize here, given my experience. Okay. The next slide is talks about what would be the appropriate valuation methodology, right? Depending on where you are in terms of the states of the maturity, right? I think we've seen in the markets, depending on where you are, I think for the early startups, if you start for the seed funding or PAA series, I think you are in a stage where you still develop, your business model, and you'll have to test and validate your assumptions to test whether your business model is really working. So typically, I think the market sort of comps and transaction comps would be appropriate, right? To see to see other companies that that are similar in nature, have got the same sort of nature of business model and type of business in the same sector, typically would give you a good idea around the range of valuation that you're looking at. But as you grow as a company, you start preparing and to scale up in the future. I think the income sort of approach would be more appropriate, because you've got more reliable data, and then you can backtest your assumptions using historical data, and also having more sort of data points to justify your forecast assumptions. I think with that, I will pass it on to JC, I think, for the Q&A section for this topic.
Thanks, Yoga, and we've had some really great questions come through, and so please do continue to post your questions in the Q&A function. Yoga, if I can come to you first, because we've had a question that is very relevant to the information that you were just sharing. There are a lot of assumptions on risks, market demand, projections, etc. when valuing a company. And the question that's come in is, how do we convince a potential investor about our evaluation without necessarily revealing the variables and exact numbers?
Very nice questions. That's a valid questions. I think I get that questions on a daily basis when it comes to valuation. So three things I would mention on that question. It's a great question. So the first one is consider case study. So look at similar types of investments and fundraise process that are similar to your sort of company, right? And then look at sort of the range of price that they've considered, right? And then and also, I think that's a good basis for us to test whether, and also to convince investors that, look at, you've got real life examples in the markets that is indicating the same range of valuation. So that's the first one. The second one is use other sources of information. When you've got a set of forecast, assumptions, use more corroborative sort of source of information. So, for example, I often do when I size the markets to project my revenue. I often do interviews with expert interviews and people that are in the business, and collect data points to justify your to test your assumptions. I think often I think investors would appreciate that if you've got more data points to support your assumptions. And the last thing is always backtest your assumptions. So having a good set of data around your, historical data, and also similar transactions, comps comparables. I think would be good to, because investors, in fact, they will consider all those data points when it comes to challenging your assumptions.
Thanks, Yoga. And before we move on to the next section, there's one other question that's come in, which I think is very relevant. And given that this was, I think, the topic that was most of interest to the audience, I'd just like to stay on this for a minute or so more. Vic, I'll ask this question to you, perhaps. Investors, especially VCs, are typically expecting an exit eventually. So the question that's come in from the audience is, do we have to pitch about our potential exit strategy, even as a social enterprise?
No, I mean, I would think there are two parts to the question. First of all, do we have to undergo the same rigor of presentation being a social enterprise as a regular company? The short answer is yes, because even in that particular domain, the capital is short, and there are not many providers of capitals. Therefore, if you are fighting for resources, you'll have to really put up your best show, I would say. So if you go with it to an investor with the possibility of exit, and you show them these are the 3 ways of exit that you can achieve, he would definitely appreciate this opportunity, and you taking time to think about his exits. More importantly, you need to understand why someone will invest in your startup. I mean, it's not charity. We are looking for social impact. And at the same time, social impact doesn't mean that everything is offered to the startups for free, right? So they would be looking for some sort of returns. While clearly they'll be looking for, say, less returns than a typical VC would expect, which we can expect in the range of 50% IRR. For PEs, we could expect in the range of 25% IRR. Often I have seen that social impact enterprises would probably operate between 10 to 15. If you're not offering that return to these people and the avenue to exit, obviously make the returns, and willingness to continue even after their exit, I would think it'll be difficult for them to show interest in investing into your business.
Fantastic. Thank you, Vic. And with that, we'll move on in the interest of time into the final topic for this session, managing your cash flow, which of course is more important than ever in the context of COVID-19. So Vic, I'll hand back to you.
Thanks, Jesse. Actually, even I'm planning my cash flow. You never know what happens in this COVID-19 situation. If you're asked to pack your bags, obviously you'll have to think about how much cash you have in a bank account. So I do understand that this is a very critical question, and we often, not only in COVID-19 situation that we are faced with today, we get these questions very often because at EY we've got a lot of tools to managing the cash flow. And effectively, if you look at it, cash flow within the business is also important for the valuation of the business, because whatever cash you have in the business technically adds up to the valuation. So these are all linked. Yeah. So if I could just move to the next slide to just walk through the basics. And the way we've structured this section, audience out there, is I'll probably just give you some introduction about how do you look at cash, and specifically in light of COVID-19, what you could do. And my colleague Yoga would cover the details about these cash flows and what levers are available to you to maximize the various sources of cash you have in the company. So what the point I was trying to make earlier is that if you have a problem, let me start by saying something which is very, very open out there. And please, I know this is like a very trite saying, but this is very relevant in this context. As they say, revenue is vanity, profit is sanity, and cash is reality. So revenue, if you look at the example of, say, traders, they would have revenues in billions, but that doesn't mean that they are rich, because effectively it's the profit that goes in their pocket. Because what they do effectively is just buy product that's worth, say, $500,000 from somewhere and sell it for $500,000 plus a margin. So that's not a big business, right? So revenue is definitely vanity. Profit is sanity, that goes to your pocket. But if you don't have money to pay to your buyers, to your suppliers, to your customers tomorrow, your business is not going to be there anymore. Therefore, cash is the king. Cash is the key, and you have to preserve it, especially in these tight situations. Also, it is troublesome to look at your business when you don't have cash in the bank account. So that is the real reason why we should always, not just in COVID-19 situation, but always have a view into what is in there in a bank account and how much runway do we have, how much cash we are burning every month. So if you look at the mature company and if you try to read the cash flow statement, I just wanted to give you some flavor of how would you read the cash. So the first box on top is operating cash flow. That is what the company makes by doing its activities. It could be, so you buy a material or you sort of buy, you create a service and you sell. So whatever you make out of it, profit, that's operating cash flow after paying taxes. So that's operating cash flow. And as long as your company is operating cash flow, you don't have any problem. And then investing cash flow, which is primarily the cash you would need to grow your business. You got to invest a lot. And sometimes this is also a source of cash if I sell something that is sitting on my balance sheet which I'm not utilizing. So i.e. sale of an idle asset. And sometimes, in COVID-19 situation, probably you'll be looking at that as well. That do I have something spare that I can sell off at the moment, which could be of better use to somebody else, and I can get some cash today. Third source is the financing source, and that is exactly what we were talking about, how to raise money externally, and that is primarily coming from your loans or it comes from your equity providers. So that's the way of looking into the overall cash flow. If the company makes operating cash flow, you don't really have to worry about investing cash flows too much. However, if you want to grow, then you have to take into account operating cash flow plus investing cash flow. And you have to think about how you have to fund this, either by using your own internal cash, which is coming from operating cash flow, or from financing cash flow. That's the overall summary of the cash flow that goes within the companies or within the business that you run. Moving to the next slide. I would say in this COVID-19 situation, it is very important, and this I think you should have done. I mean, people should have done a little bit in advance, and if not, obviously there's a lot for you guys to do because we are still in the startup phase. Just think about it from a very simple perspective of matching your assets to your liabilities. I mean, that's a very simple fund that we utilize in our life as well. I would need cash for my son's education. How much do I need, and how much do I have to save today? So it's that principle. So if I were to invest in capex, and that's typically a huge amount of cash, I would go to my bank, and I would not probably be relying on my personal pockets to fund that. And that's the principle that we use different sources for different uses. And what this does is gives you flexibility. At the same time, it also lowers down your cost burden or your interest burden, because as you would note, an overdraft facility has a relatively lower interest burden than a term facility. So you got to have flexibilities on that. Most important is point number 2, and we help at EY the companies with getting them ready for the forecasting, so cash forecasting capabilities. And in this era, in this time, COVID-19, we've been getting huge number of requests to try to help them. I mean, asking us to help them with a 13-week cash flow plan. So if you have a flexibility of modeling your cash flows, nothing like it. There are a lot of sources internally that you could utilize to improve your cash position. And these could be, as I mentioned earlier, to sell your non-productive assets that are lying idle. That'll be a source of cash. Or you could improve your cash handling procedures so that everything you earn today goes into the bank account immediately so that it earns the interest. And also the working capital management cycle could be improved. And there is, believe me, if the company is mature, there's a lot of cash which is trapped in the working capital. And if we can make it efficient, we can release a lot of cash. And that is exactly what my colleague Yoga is going to walk you through in the next section.
Thank you, Vic. Okay, so I think I've got a couple of slides to cover for these sections. I think I'll start off with a couple of examples on the source of financing, and then we've got a couple of slides talking about more deeply around how you improve the overall working capital cycle. Okay, so the first slide, I think on the sources of financing, I think just to build on what my colleague said earlier on, I think when you look at property, plant equipment, and working capital, you've got typically in the market, you've got different types of sources of financing. So on the PPE, I think typically we use term debt, and of course when you look at the pros and cons, I think term debt is generally I think it's got better flexibility compared to that of assets financing. But the cons is that the interest rate could be higher. Whereas on the asset financing, I think you don't have the ownership of the assets, but typically it's got low interest rates compared to that of term debts. Moving on to the working capital, I think this is essential. I think especially during this COVID-19, I think we need to make sure that you've got sufficient sort of credit facility with banks. I think having the short-term revolving facility to support sort of your working capital requirements is essential. Though I think it's quite flexible to have the revolving facility. I think the considerations that we need to be aware of, that the interest rates could often be high. So whereas on the inventory financing, typically we see that it seems to be more risky from the lender standpoint, but it is essential to have that in place, to make sure that you've got support as to finance your working capital. Especially in these days, with this COVID-19 situations. Receivable factoring could be something interesting when it comes to utilizing the receivables that you've got on your balance sheets. So deploying that, I think we've seen that in the markets. Some of the fintech in ASEAN, I think I think we're seeing an increasing trend on that. Though I think the interest rate is typically higher, but it's good. It's a good way to sort of utilize your receivables to support your working capital. Moving on to the next slide. So I think I totally agree with what my colleague Vic mentioned earlier on. The cash is king, and looking at it from the perspective from investors, I think your ability to be able to provide visibility around your cash positions, right, and also having a good track record historically to justify your forecast assumption going forward is essential, right? Because essentially, I think investors would like to see, how much cash you can generate from your operation activity, right? To give them confidence and comfort around, your business model and your ability and your discipline to collect cash and making sure you've got enough to support your working capital. Generally, I think we've got two primary methodologies, right? Direct and indirect. In the market, I think we often see that when it comes to fundraising, I think we typically use the indirect methods. But I think for more detailed short-term cash flow forecasting and management, I think direct method is preferred because it's got the details at ledger level on the receivables, payables, as well as the monthly payment obligations that you ought to monitor on a daily basis. How does the working capital cycle work, right? So I think from the process standpoint, you've got order to cash. So looking at it from the customer standpoint, it all boils down to how much cash you can generate and how quickly you can generate that, right? I think on the next slide, I think we will talk about a bit more around the CCC, the cash conversion cycle, which is driven by three things essentially, right? So you've got the process run to collect cash from your customer. So you start with doing the sales activity and managing the credit risks. And also, when you do the sales, that needs to be done in conjunction with how you forecast the demand and planning. Because the key indicators here boils down to what is the average time taken, right, to collect cash from your customers. How many days taken to get your customer to consume your inventory, and also can we negotiate better terms with our supplier, right, to be able to improve the overall working capital cycle. So we call this as the concept is cash conversion cycle, which is an important cycle. And also when it comes to going back to the income approach, when you estimate your forecast assumptions, when you do your business plan, this will play a big role when it comes to presenting this to the investors, because investors typically will ask sort of your ability to manage the working capital. How much cash is tied up on a monthly basis? Yeah. Moving on to the next slide, please. Okay, so what are the key levers that we can consider, right, to improve the overall working capital, right, and release cash as quickly as possible, right? A couple of things to mention here from the DSO standpoint, which is the time taken for us to collect cash from our customers. You can look to reduce the collection process, making sure that when you do the sales, you start billing, and you've got an efficient process when it comes to collection. And also perhaps look for rooms to negotiate with your customers, right? And introduce some early payment discounts to get more cash quicker. And also strengthening the overall collection and credit management activity governance within your organizations. I think that will play a big role going forward to make sure that you've got cash quickly and steadily in your forecast. And DIO, I think try to rationalize the number on product and supplier. Try to improve alignment with your sales forecast and production planning. I think those are the key items. And also on DPO, right? So I think this is as a real example with this COVID-19 situations where I think people are faced with the fact that I think they need to look for rooms to negotiate with the suppliers, to reduce the level of cash that is tied up in the working capital. I think overall, all in all, if you're able to manage this well, I think this will play a big role when it comes to preparing for investment and convincing investors from their standpoint. With that, I think I'll pass it on to Jessie for the Q&A section.
Fantastic. Thank you, Yoga. And in the interest of time, I'm going to suggest that we move into the wrap up. However, I would say to the audience, please do continue to post your questions, because we will ensure that actually we follow up on all of the questions that you pose, even though we haven't maybe been able to cover them in this session live in the webinar. So before we close, I wanted to share with you some of the follow-on resources and services that you can access in addition to this webinar on these topics. So as I mentioned at the top of this call, EY extends the value of our knowledge and networks to impact entrepreneurs in a number of ways to help them achieve greater scale and impact. You can access free EY insights and tools in relation to COVID-19, including the easy to use and self-service digital enterprise resilience tool, which enables businesses to assess their COVID-19 response against 9 areas of enterprise resilience. You can also access a number of the not-for-profit resources and services that we've designed specifically for impact startups. This includes professional services, where we provide full-time, hands-on support to businesses globally for typically up to 12 weeks to help them overcome barriers to growth. It also includes skills development and coaching sessions, including webinars just like this one. And finally, we also provide digital tools, including EY Velocity and EY Finance Navigator. EY Velocity is a free digital platform that helps ambitious entrepreneurs like you to accelerate their growth journey using our established EY 7 Drivers of Growth framework. And the EY Finance Navigator is an online financial planning tool, which enables enterprises to build financial plans and make cash flow projections, which can be exported into Excel, and which is trusted by entrepreneurs in more than 50 countries. So very relevant to the topics that Yoga and Vic just shared. And in light of COVID-19, we have made the EY Finance Navigator free for 3 months if you register before the 31st of July. And outside of this, in general, we also offer a 75% impact discount for impact startups. So if these resources are of interest, then please do check out our impact entrepreneurship site on ey.com to access them. And I've shared the link to this through the chat function so you can access it. So we'll end here, and I'd like to just say another thank you to AVPN for collaborating with EY to bring this webinar to life. And also to Vic and Yoga for sharing their time and their insights with you all today. And finally, of course, to you all for tuning in and taking time out of your busy schedule to join us today. I hope you all have a wonderful week, and I hope you found this webinar relevant and insightful. And importantly, I wish you all good luck as you prepare for investment.